Rio Tinto reported a record profit thanks to higher iron ore and copper prices. The world's third largest mining company also announced it's raising its dividend by 40%, also buying back $5 billion in shares. Joining us now from the floor of the London Stock Exchange is Rio Tinto's CEO, Tom Albanese. Tom, thanks so much for joining us this morning. I want to ask you about the stock's reaction because you raised the dividend, you announced the buyback, yet Rio's stock is moving lower in London. I'm looking at some analyst reports saying that $5 billion share back should have been more like $15 billion. Are you conserving cash for a reason?
Well, I think, first of all, I am very pleased with our performance. We've had record earnings, record cash flow. I think you've seen strong share performance over the past year. You've got to avoid looking too much at day-to-day movements because there are broader things that go on an individual daily basis, and we've got to keep our eyes on that horizon. I think if I look at what we've announced, nearly $2 billion of cash flow during the course of 2010. We've announced roughly $12 billion of new project growth, and these are very important value projects. We're improving the quality of our balance sheet. We're bringing down our debt to a little over $4 billion, and we've had enough cash flow that we can return capital to management. And I think if I look at the 20% year-on-year increase in our progressive dividend and $5 billion capital share back, all the people I've been talking with over the course of the past couple hours have had smiles on their face. Now, I've seen one analyst report making reference to $15 billion, but if I say the broad variety opinion, people would say, job well done. Because
we know that your peers are offering very competitive dividends as well. I'm just looking at Brazil's Vale, for example, 67% increase. Xstrata saying it would triple its payout, so it seems like a lot of the mining companies such as yours, obviously along with yours, trying to give back some value to shareholders. I want to look forward though, Tom, because part of the world's growth story is based so far on what China has been doing. Now, just earlier this week, we saw China tighten, economists saying more tightening to come. What does this mean for Rio Tinto? We know China's your biggest customer.
I think so far we have been watching the tightening closely, but also recognizing that it's probably on balance been appropriate toward preserving what I call long-term growth trends in that 8% GDP range. We'd all love to see a year or two of 12% GDP growth from China, but that probably wouldn't be sustainable, and that would set us up for a shock down the road. So as we look longer term, as we recognize that a lot of our new expansions are going to not deliver tons until 2013 and 2015, I would rather see some moderation of growth. And again, from our perspective and our businesses, 8 to 9% GDP growth is certainly fits within a good working environment from Rio Tinto. We increased our overall business in China from about 24% in 2009 to about 27 or so percent, 28% in 2010. So it is an increasing part of our revenue mix. But again, what we've been seeing so far is a pretty good balance in terms of not getting too hot, but then also not cooling down too fast.
Well, you bring up a really good point, Tom, about controlled growth. And I mean, it's not just about China. You can look at India. You can look at Brazil. I mean, do you think the emerging market economies are going to be able to see sustained growth? In other words, not bubble growth, sustained growth throughout next year?
I think for us, we have to look even beyond next year. We have to look out for the next 10, 20 years, because that's really the life of the investments that we would make. And we see tremendous drivers for urbanization. We see 2.5 billion people in the world that actually want to live in a better form of life than and better standard of living than their parents. And that will have a positive effect on the consumption of what we produce. So we look positive on that, but we also recognize that in the nearer term, while it looks pretty good today, and GDP numbers for the globe are roughly in the 4 to 5% range, that's a very, very positive number. We also see big imbalances. We see sovereign risk issues in Europe. We see high unemployment in the U.S. We see low GDP growth in Japan. We see emerging inflation risk in emerging countries. All of these have the effect of increasing our wariness about volatility. Volatility of global markets, but also volatility in our specific commodity markets. So that's why we want to go into 2011 with a sense of optimism, but sufficiently caution that we want to have a strong balance sheet.
Tom, we thank you so much for the time. Tom Albanese joining us there from London. He is the CEO of Rio Tinto.